Hello, and welcome back to the channel. Today, we're diving into one of the most critical topics for any investor: risk management in investing. Have you ever wondered why some investors consistently succeed while others struggle to stay afloat? The answer often lies in how well they manage risk. In this video, we'll discuss practical strategies to protect your investments and minimize potential losses. Whether you're new to investing or a seasoned trader, mastering risk management is essential for long-term success. So let's get started. Risk in investing refers to the uncertainty surrounding the outcome of an investment. No matter how well researched, every investment carries a degree of unpredictability. But understanding risk is the first step toward managing it. Let's break this down. Higher potential returns often come with higher risks. For example, investing in a volatile cryptocurrency like Bitcoin offers potentially huge returns, but comes with the chance of substantial losses. On the other hand, government bonds provide lower returns, but are generally safer. Without risk, there's no reward. Investors must embrace calculated risks to achieve their financial goals while safeguarding against devastating losses. Market risk arises from fluctuations in the broader market, driven by factors like economic recessions, political events, or natural disasters. During the COVID-19 pandemic, global stock markets plummeted due to uncertainty, affecting almost all asset classes. To mitigate this, invest in diversified asset classes, such as combining stocks, bonds, and commodities. Credit risk is the risk that a company or bond issuer cannot meet its debt obligations. A company defaulting on its bonds could lead to significant losses for investors holding those bonds. To mitigate this, stick to bonds with higher credit ratings, like AA-rated government bonds, and evaluate the issuer's financial stability. Liquidity risk is the inability to sell an asset quickly without incurring a loss due to lack of market demand. Real estate often faces liquidity risk, as selling property can take months or even years. To mitigate this, balance your portfolio with highly liquid assets like blue chip stocks or ETFs. Inflation risk is the erosion of purchasing power due to rising prices, which can diminish the real value of returns. Holding cash during a period of 8% inflation means the real value of your money is decreasing annually. To mitigate this, invest in assets that historically outperform inflation, like equities or inflation-protected securities. Operational risk stems from internal system failures, fraud, or poor management. A company mismanaging its resources or failing to adapt to market changes can result in bankruptcy. To mitigate this, research companies thoroughly and prioritize those with a track record of transparency and efficiency. Investing isn't just a numbers game, it's deeply tied to human psychology. Understanding how emotions influence decisions is critical for risk management. In- Investing isn't just a numbers game, it's deeply tied to human psychology. Understanding how emotions influence decisions is critical for risk management. Fear emerges during market downturns, causing investors to sell prematurely, often locking in losses. During the 2008 financial crisis, many investors sold at the bottom, only to watch markets recover shortly after. To combat fear, set predefined rules, such as using stop-loss orders or risk thresholds. Avoid frequent portfolio checks during volatile periods. Reassess your financial goals and understand that short-term dips often don't impact long-term returns. Greed surfaces in bull markets, encouraging overexposure or chasing speculative assets. Investors piled into meme stocks during the GameStop rally without understanding the risks, face substantial losses when the hype died down. Stick to your investment plan even during euphoric market phases. Regularly review asset allocations to ensure you're not over-leveraged in high-risk areas. Avoid FOMO. Markets will always present new opportunities. Developing emotional discipline is as essential as mastering technical and fundamental analysis. Recognizing how fear or excitement affects your decisions allows you to create safeguards. Keep a journal of your decisions and reflect on whether emotions influence them. For example, did you sell because of panic or because your strategy dictated it? Overconsumption of news and social media can amplify emotional responses. Set boundaries for information intake. Follow credible sources and avoid basing decisions on sensational headlines. Watching others seemingly make quick profits can create impatience, pushing you toward risky moves. Great investors like Warren Buffett emphasize the power of long-term thinking. Most of his wealth came from decades of compounding, not short-term trades. Practical tools can help you counteract emotional tendencies. Automate investments through techniques like dollar cost averaging, where you invest a fixed amount regularly, regardless of market conditions. This removes emotional biases and ensures consistent contributions to your portfolio. Spreading investments across asset classes, sectors, and regions can reduce the emotional strain of losses in a single area. If one sector underperformed, gains in another can balance your overall returns. Set clear risk-reward ratios for every trade or investment. For instance, only take positions where the potential upside is at least twice the potential downside. Imagine worst-case scenarios before investing. If a 20% drop in a stock's value makes you uneasy, you may be overexposed. Adjust your position size to align with your comfort level. Investing isn't one size fits all. Understanding your unique risk tolerance will help you manage stress and make better decisions. Factors to consider include age, financial goals, and emotional capacity. Younger investors typically have more time to recover from losses and can take on more risk. Are you investing for a home in 5 years or retirement in 30? Short-term goals require safer investments. Can you stomach a 30% drop in your portfolio without panicking? Conservative investors should focus on bonds, dividend-paying stocks, or ETFs, while aggressive investors might allocate a larger percentage to growth stock or even speculative assets like cryptocurrencies. Instead of fearing downturns, view them as opportunities. Historically, market corrections paved the way for growth. The 2020 market crash was followed by a record-breaking bull run. Tracking incremental progress, like achieving a consistent 7% annual return, helps maintain motivation and confidence. Compounding is the ultimate tool for wealth creation, but it requires patience. A $10,000 investment growing at 8% annually will become over $100,000 in 30 years. Emotions are a natural part of investing. They don't have to control your decision. By practicing discipline, using automation, and focusing on long-term goals, you can transform emotional risks into opportunities for growth. The key is to develop habits and strategies that reinforce consistency, even in the face of market turbulence. Remember, the greatest investors are not those who avoid risk entirely, but those who understand and manage it effectively. Stay grounded, stay informed, and most importantly, stay true to your plan. Risk management isn't just a skill, it's a mindset. By setting stop losses, diversifying your portfolio, sizing your positions carefully, and staying emotionally disciplined, you can minimize losses and protect your financial future. So, whether you're trading stocks, cryptocurrencies, or real estate, always prioritize managing your risks. The goal isn't just to make profits, it's to keep those profits safe. If you found this video helpful, don't forget to like, share, and subscribe to the channel. Let us know in the comments below. What's your go-to strategy for managing risks? Until next time, happy investing.